Hello guys and welcome to another video. My name is Mark, I'm an entrepreneur and property investor, and in today's video we're talking about how inflation and higher interest rates might actually be really good news for property investors. And you're going to have to stay with me because I know this is quite a controversial subject matter and I know my thoughts on this are quite controversial, but when you look at the data and you start to think about it, it makes perfect sense. Now, the first thing I want to think about is inflation as a whole. So if we consider that the property market over the last 12 months has pretty much stagnated. If you look at the data, it's about a zero gain over the whole of the UK. Now, there are going to be regional pockets that have done really well and regional pockets that have done worse. Of course there will be, but it's about a zero gain. And in the same time, in the same 12-month period, we've experienced inflation of about 8 to 10%, depending on which month you're looking at. If you're looking at last month, I think it came in at 10, this month 8.7. So we're looking at inflation around 10%, and it's a nice number, isn't it, 10? We'll be able to do lots of maths with that, so we'll stick with that. Interest rates are currently 4.5%, so we have a base rate that's below the rate of inflation. So what does that mean? That means essentially if you borrow money today in real terms, you're going to pay back less than you borrowed in real terms. I.e., if the inflation rate's 10% and you're borrowing at 4.5%, then the money is shrinking in value at 10% right now, in terms of real terms wealth. But the really interesting thing is property prices are also shrinking at 10%, even if they stay stagnant, even if they stay the same. And I know that's quite a bit to get your head around, but if everything else is going up in price, if wages are going up in value, if all these other things are growing but property prices stagnate, then relatively speaking, they are dropping in value. And this is my thoughts when it comes to this sort of stuff. Interest rates are pushing up. What's that had on the rental market? What effect has that had? Well, rental demand is still extremely strong, and there's no units available because we have a supply and demand issue. We don't have a price issue, we have a supply and demand issue. More than anything else, there are people turning up to rent properties, and certainly in my portfolio, we are pushing rents up. We're pushing them up significantly. In Sheffield, we've just rented out a 3-bedroom house, which no more than, 24 months ago, we'd be renting that out for $650. We just rented it out for $950. That's a massive difference. So rents are increasing significantly. That means that your costs, i.e. your increased interest rates, are not going to affect you as an investor as much as you might think they will. When you start doing the sums, when you start looking at the new rents you can charge, they are all baked in. And the reason is because as investors, if we're not able to make a profit, we don't do the deal. We simply would start to sell our assets and then supply would drop even more. Housing is an essential product, so demand isn't going to go away. People aren't going to suddenly go, well, I'm quite happy to live on the streets. They're going to cut back on other things first. So I believe that right now, with inflation being where it is, with interest rates being where they are, and with rental prices increasing at the rate that they are, I've never seen such a buoyant market. Now, in terms of house price growth in real terms, we saw a much more buoyant market in 2020 through to 2022, didn't we? We saw so much money enter the market, and there is still a lot on the sidelines, and people pick up really cheap loans, really cheap mortgages, and inflate the value of those assets massively. Now, lots of people thought that we'd have a big house price crash, and I was one of the people that sort of sat on the fence and said, well, maybe it crashes, but more likely it stagnates, because it's quite an emotive purchase. People don't like to sell houses for less than they bought them. They don't like to sell them for less than they were last year, to be honest. They just hold on. It's an emotive purchase, it's an emotive thing to sell. So what you tend to find, certainly in the housing market that I've experienced, now 2008, that was a slightly different sort of scenario. That was a tightening of credit. We're not there today. We're not in a position where there's a tightening of credit. We're in the position where there's more expensive credit, but it's still available. And I think we've kind of learned from that playbook back in 2008 that if credit does tighten up, then the central banks step in and make sure that lending is still effective, because the liquidity side of things is still incredibly important for the much wider economy. And ultimately, Everybody wants to grow the economy because by growing the economy, you increase tax revenues, you reduce the amount of percentage of the national debt, you also reduce the household debt as a whole. You know, if your wages are growing, your net worth's growing, all these other things are growing, then the household debt that maybe was 100,000 has just reduced by whatever inflation was over that period of time. And I think we just haven't had much inflation for the last sort of 5-10 years. We're taking it all at once. 2008, we printed loads of money, we didn't get inflation. 2020, we printed loads of money, and guess what? This time we did. And I think the reason we did is because we told people to stay at home. So they saved loads of money. They didn't go out and spend it and trickle it into the economy, and the companies weren't able to react the way they normally would. Because companies would normally just produce more products and services. And by doing that, they would keep the supply up to where it needs to be, and demand might rise, but they would just rise supply and make sure that they were providing what the market were looking for. So we're in a slightly different environment at the moment. What I do feel like is a lot of those supply constraints are coming to an end. I think that the governments are very, very keen to try and bring inflation under control. I think that central banks are very keen to try and bring inflation under control. And higher interest rates are just being passed straight on to the renters and onto the mortgage consumers. And remember, I have a lot of mortgages. I have £1.4 million worth of mortgages. So every percent that increases by, it costs me £14,000 a year. But if I can charge an extra £14,000 a year, it's a nil gain for me. And that is what I'm finding. I'm finding that as interest rates increase, so do the rentals that I'm able to charge. So I'm now much less worried about increasing interest rates because I do believe there will be a finite end to that. I think the Fed have signalled that they're reaching it. The Bank of England has signalled they're reaching it. I think as a whole we accept we're kind of reaching the end of where we need to raise interest rates. And there'll be one of two things, right? Either we will get a snapback, i.e. the economy will start to shrink, recession will enter, people will start to lose their jobs, and the central banks will know that they have to inflate and get money out there so that people can employ and grow and all the rest. That is one scenario. The other one is one of stagnation, where we accept much lower growth for a longer period of time. We accept that things like assets are going to inflate over a period of time and debt is going to become deflated, i.e. become worth less. Because as you have inflation, that 100 grand's worth of debt you had before, today is worth, let's say there's been 15% inflation over the last 2 years, well, it's worth 15% less today than it was there in relative terms. And it's, again, quite a lot to get your head around, I think. But remember, if you hold the assets, if you own the assets and you own the debt's going down in value relatively because the amount that you borrowed is fixed, and the asset is likely to go up in value because of the cost of building it, the amount of money people have in their pockets, not in real terms, but in nominal terms, in the figure, the number. If they earned 2,000, they now earn 2,200. That'd be a 10% increase. The nominal figure has increased, therefore the nominal figure of the asset normally follows suit. So guys, I think today is an incredibly exciting time to be part of the property investing community. There's lots of people who've been worried, lots of people who've sold up. Demand is still there. There is strong, strong demand, and rents are hitting record numbers. And I think if you can weather this storm, and there's no doubt it is a storm, as a HMO landlord, I can tell you, higher interest rates, higher energy prices, my profit's been gone for a year. But I can see the end, and I can see that the assets have gone up in value over that period of time. The debt has gone down in value over that period of time. And if I can hold on, which I can, and keep on making sure that I'm balancing with the market, then this is possibly the best time to be investing in property. And it's possibly the best time to be able to strike a deal that you've had in the last few years. Again, there are lots of regional nuances. I'm doing great stuff up north, down south. I personally wouldn't be touching it right now. I think the mortgage levels that we have down south and the house prices we have down south are going to be very, very prohibitive because there is only a certain amount that people can pay in rent and in mortgages. And when you've got higher values down south, that I think is a risk factor. Let me know your thoughts in the comments. I'm massively interested. I will reply to every single one of you. Like and subscribe as always, and I will see you on the next one. Cheers, guys.